Today's class is Indian Financial Institutions under Indian Financial System. I'm Dr. Srimati from Dr. Ambedkar Global Law Institute, Tirupati.
Start with an introduction. The system which enables the lenders and borrowers to exchange the funds. So here the system has, that is Indian financial system, has been controlled by independent regulators in the sectors of, in different sectors. Okay, so in the sectors of insurance, banking, capital market and various service sectors. Okay, and so we can say that the Indian financial system plays a significant role in the growth of economic growth of a country. So how it could be possible? It is possible by mobilizing the surplus funds and utilizing them effectively for productive purpose. And the next one is features of Indian financial system. So here it plays a vital role in economic development of a country, and it encourages both the savings and investment, and it links the savers and the investors, and it helps in capital formulation, and it helps in allocation of risk, and this finally it's about the financial system facilitates the expansion of financial markets. So let us see what constitutes an Indian financial system, or else we can say that the components of Indian financial system. So there are four major components in the system. That is starting with the financial institutions, financial markets, financial instruments and financial services. We are going to see in today's class the financial institutions. Okay, so what is Indian financial system? We come to know that is components of four, and particularly we are going to start all these four, we are going to say it one by one, but today's class is Indian financial institutions. Okay, so what are constitutes the Indian financial institutions? Okay, so this financial institutions we are dividing. Okay, so it's about an intermediaries who facilitates the smooth function of financial system by making the investors and borrowers to meet. So here it is about an institutions which makes the intermediaries. Okay, so it acts as an intermediaries, and then as if you know it acts as an intermediaries. So how it is about accepting the deposits from the person who are having the excess amount, and then advancing the loan to the borrower who are in need. The next one is it's about it acts as mobilizing the savings of surplus units. So those who are having excess. Okay, so that surplus to be collected and allocated them to be productive activities. Suppose if it has been kept in idle, if it has been kept in a locker, or if it has been kept in a drawer, then it won't be in any use. So it's about so the savings should be mobilized in such a manner to make them in a productive activity. So, and it's about mobilizing the savings. The financial institutions, they are mobilizing the savings. So it's here mobilizing the savings. It says there are certain savers, okay, who are having the surplus of money. So that surplus should be deposited into a bank or any institutions. Then it could be the bank could grant a loan to the borrowers, and the borrowers repays the loan again. It goes. Okay, it's like a circle. Okay, so the financial institutions, they play a vital role in mobilizing that, and it provides a whole range of services to the entities who want to raise the funds. So here this is about they provide. So that is in the case of the individuals, business, and then government who are need of the fund. Okay, for them, this institutions, they are just providing the wide range of services. Okay, variety of services for raising this type of funds. Okay, so this savings, and then it services to raise the funds. How they are just making the services to raise the fund in a sense. So here it's about a financial intermediary, whether it is about a direct finance or indirect finance, which has to be collected from the households. Okay, so even a small amount which has been deposited in a bank can give a better usage to the productive purpose. Okay, a small drop which will create a ocean like, okay. So here it's about an households or business firms or the government or the foreigners who makes either direct or indirect finance, then directly it goes to the borrowers or to the spenders, okay. And then again the person who are spending, who are the borrowers, again we can say the households, okay, who are in need, and business firms, government, foreigners. So here it's about, again it's like a circle, and they are making a service. The financial institutions, they are making the service, and we are going to divide the financial institutions in two cases, two types, that is banking and non-banking. So here banking institutions we are again going to divide into two, that is organized sector and unorganized sector. See, under organized sector there is about commercial banks, cooperative banks, regional rural banks, foreign banks. And under the unorganized sector, indigenous bankers and then money lenders. So here the next we are going to see is the commercial banks, that is under organized sector. The commercial banks we are going to see. So what is commercial banks? You come to know already in the last video we have given lots related to the banks, okay, the functions of a commercial banks like. So what is the term commercial bank means? Actually it's an institution that accepts the deposits and offers checking accounts of services and making various loans and offers the basic financial products. Especially we can say that a certificate of deposits like, okay, and they are providing the savings account to the individuals and current account to the firms and businesses, okay. Likewise we can say the numbers, okay. So that refers to the commercial banks. It's an institutions, they are just collecting the deposit and lending the loan. And the next one is the cooperative banks. So here it's about an important segment of an organized sector of Indian banking, that is cooperative banking, okay. So here it represents, okay, that is this segment is represented by group of societies which has been registered under the acts of the states, which has been related to cooperative societies, okay. So here these cooperative societies may be credit societies or non-credit societies. So here this type of different types of cooperative societies which are operating in Indian economy means we can say that the rural credit societies, those who are primarily concerned with agriculture, okay. And then the next one is that is urban credit societies. So they are just having the societies of non-agricultural activities, say for example granting housing loans and providing various other loans in the finance sector, that is urban side, okay. And then the next organized sector has regional rural banks, we can say RRBs. So here these RRBs were set up by the state government, okay, which are sponsoring the commercial banks with the objective of developing the rural economy, okay. So this has been done particularly with the recommendation of Narasimhan committee, and then the main objective of this is that is this regional rural banks will be much better than the commercial banks or cooperative banks in order to meet the needs of rural areas like, okay. So this has been a recommendation which has been given by the Narasimhan committee, and here it's about the word which has been given by the committee, that is combine the local feel and familiarity with the rural problems which cooperatives possess and and accepting how it has been started, that is accepting the recommendations of the committee. The government passed the Regional Rural Banks Act 1976, and in order to provide credit and other facilities particularly to small and marginal farmers and agricultural laborers, okay. And then why it is so? In order to develop agriculture, trade, commerce, industry and other productive activities in the rural areas. And the next one is the foreign banks. So the foreign banks have been in India from the British days. So the foreign banks that have branches in the other countries, and mainly the headquarters in the home. Then with the deregulations in 1993, a number of foreign banks just they are entering into India. Now there is about a number of foreign banks in India. Example, the next one is unorganized sector. We are going to see it. Okay, so this is about an indigenous banks, money lenders. and who operates as a banks, and they just collect the deposit from the general public and grants loan to the needy people. Okay, and then they also like acts as an intermediary, like a financial other financial institutions. Okay, so here they has to be they should be distinguished professional, many, that is money lenders who primary business is not a banking. Okay, so their primary business is not a banking, but they used to do this banking business. So this fund could be used out of their own fund or from the deposits. Okay, so this indigenous bankers, they are popular in villages and small towns. Okay, so they perform the combined function of trading their own family business of trading or business and then banking activities. And here the individual bankers you come to know, sharafs, seths, shakuras, mahajans. So all those people you come to know in your day-to-day life. Okay, so those people are individual bankers who collects some deposits, or they may use their own fund and they may lend the money to the needy people. Okay, and they do the trading and other business with the money lending. This is important. So it varies. Those indigenous banks vary in size from petty lenders to substantial sharafs. Okay, and they act as money changers and financial internal trade through hundis. Okay, and hundis and commercial papers also they used to deal it. Okay, and usually this type of thing is family owned business employing their own working capital. And the money lenders also we have seen. Okay, who are out. Then non-banking financial institutions, that is non-banking financial companies. So what is about non-banking financial institutions are registered under Companies Act 1956. See, the banking institutions are regulated under the Banking Regulations Act. So their business is accepting the deposit and lending the money. But here these companies are registered under the Companies Act 1956. So their main business is not accepting the deposit and lending the money. Okay, and here this is about, and again we are going to divide this. That is what they are going to do is they are going to perform the lending functions for the public, and then they do not have a full banking license, that is, or they may not have be supervised by national or international banking regulatory agencies. They are not allowed to take deposits from the public because as they are just done by the banks. Okay, and then they do facilitate alternative financial services such as the investment. Both it has been for the collective as well as for the individual, and risk pooling and financial consulting and brokering and money transmission and number of services they used to do it. Okay, and they serve as a competition to banks. Okay, so number of functions which has been done by banks are done even by the non-banking financial institutions, and particularly they will be very much specialized in some sectors or in groups. Okay, and the next one is the objectives of non-banking financial institutions. So what are the objectives? In the sense it provides a long-term credits and growth of national income it provides. Okay, and then generate employment opportunities, since a number of person who are collecting money from these institutions, they are starting small, medium and micro enterprises. Okay, and then the movement of funds from one place to another place where there is about a need and better living standard. Okay, so when they collect money and they do business and their standards will increase, and then strengthening the financial market. And non-banking institutions again divided the organized non-banking financial institutions and this are unorganized. So under unorganized non-banking financial institutions, again we are going to divide this into development finance institutions and investment institutions. And the next one is unorganized non-banking financial institutions. And what is development finance institutions, DFI we can say. Okay, and then this is about this includes, okay, institutions like IDBI, ICICI, IFCI, IIBI, IRDC. So this is about an all India level and SFC and SIDC. So this is about a state industrial development corporations. They are playing at a state levels, okay. And then NABARD and then land development banks, okay. And then land development banks which for the agricultural and industries. And the next one is investment institutions. So this includes the financial institutions which mobilize savings at the public at large through various schemes and invest these funds in corporate and government securities, okay. So you come to know how they are mobilizing savings from the public at a large, in the sense LIC. So the public, they used to get the number of policies in life insurance corporations and then general insurance corporations and then LTT and mutual funds, okay. To know day to day life the number of investment institutions they are having, and then they are just mobilizing the savings from the. And the next one is unorganized non-banking financial institutions. So this is about include a number of non-banking financial companies, that is they used to do the banking services, the provider, the whole range of financial services to the people. So the services includes hire purchase and then consumer finance companies and then leasing companies, housing finance companies and factoring companies, credit rating agencies. Hope you understood. Until the next, it's bye from Srimati. Thank you, and thank you for watching the full video.